Welcome to Alpha Insights. I'm Hope. Today we're unpacking a busy day in tech. Big AI funding, new product moves, and some thorny legal and power issues. With me is William, a professor of economics who helps investors cut through the noise. William, great to have you.
Thanks for having me, Hope. Lots to cover. This was a day where growth and risk showed up side by side.
Let's start with Google. I heard they filed an appeal after a judge found their search business illegal last year. What's going on, and why does it matter for investors?
Right. Google asked an appeals court to pause the remedies ordered in that ruling. Practically speaking, filing an appeal doesn't automatically stop anything. A judge has to grant a stay. If a stay is granted, big structural changes could be delayed. If it's denied, enforcement pressure ramps up. For investors, that affects how you think about regulatory risk to core search revenues and related ad businesses.
At the same time, there are reports Google is negotiating a joint venture with a fiber company and a big infrastructure investor, putting in about $1 billion. How should we read that?
That tells you two things. One, Google is still investing in physical network infrastructure. Fiber helps its cloud and AI services perform better. Two, bringing in outside capital via a joint venture can shift costs and risks off Google's balance sheet. It's an operational hedge while legal uncertainty looms.
Switching to AI funding. ClickHouse raised about $400 million and now has a roughly $15 billion valuation. 11 Labs may be raising at about $11 billion, almost double a recent secondary valuation. Is this froth or a genuine signal?
It's both enthusiasm and rationale. Large private rounds show investor appetite for companies that enable AI, databases, analytics, and generative models. For ClickHouse, the raise underscores demand for analytics platforms that compete with incumbents. For 11 Labs, the jump signals excitement around voice and generative tools. But whether public markets reward them later depends on revenue growth, margins, and how they convert interest into paying customers.
We also saw product moves. OpenAI added a ChatGPT Go option at an $8 tier, and competitors are pushing into code and media tools. What should investors watch here?
Focus on adoption and retention. How many users sign up, how many stick around, and whether these tiers lead to meaningful revenue per user. Competitive launches like a code-focused assistant matter because they can shift software workflows. That can be a revenue driver if firms convert free users into enterprise customers.
Now the tougher headlines: power and compliance. The EPA found that one company operated 35 natural gas turbines without permits. And there's political pressure for the regional grid operator PJM to hold an emergency auction to incentivize long-term power plants. Why does this matter to tech firms and data centers?
Running on-site generators or private power plants requires careful permitting. The EPA action shows compliance lapses can lead to fines and reputational damage. The PJM proposal pressures big cloud and data center operators to sign long-term power contracts or otherwise help fund new capacity. That could raise energy costs, require upfront capital, or force operational changes. All meaningful for companies with huge power needs for AI workloads.
So, for investors, what's the practical takeaway when you see fast growth in AI but rising legal and energy risks?
Be selective. Favor companies with diversified infrastructure strategies, those that can shift workloads across regions or contract for power long-term. Prioritize firms with clean compliance records and clear paths to profitability. And be realistic about timelines. Legal rulings and grid decisions can take months, even years, and they can force capital reallocation.
Anything specific people should track in the coming weeks?
Yes, watch appellate filings for Google's appeal. A stay would ease near-term disruption. Track any PJM auction decisions or state-level energy procurement rules. And monitor how ClickHouse and 11 Labs say they'll use fresh capital. Is it for product expansion, enterprise sales, or just accelerating growth?
Before we wrap, give our listeners 3 quick, actionable takeaways.
First, treat AI and infrastructure as high growth, but also high risk. Invest in companies that show clear unit economics. Second, factor non-market risks into valuations. Legal timelines and energy policy can change costs quickly. Third, look for firms that offload infrastructure risk through joint ventures or long-term contracts. Those moves can protect margins.
Great points. To recap in short, growth is alive in AI and infrastructure, but watch legal appeals, power policy, and how new funding is put to work. Thanks, William. That was really clear.
My pleasure, Hope. Thanks for having me.